Hi, everybody. I hope you're all doing well. My name is Paul Dingkuhn. I'm a PhD candidate at Wageningen University, and today I'm going to talk a bit about transforming economic systems for nature and equity. And in particular, I'm going to focus on the case of the EU financial sector. So, why does it make sense to target finance when we talk about transformative change? Well, when we look at the latest reports from the IBES on transformative change, we can see that transforming economic system for nature and equity is presented as one of the 5 complementary strategies to bring about transformative change. And within the strategy, we can see that transforming financial system is also explicitly mentioned, as you can see here. And this makes a lot of sense because the financial sector is not a natural component of the economy. The way it allocates capital, the way it manages and assesses risk, and also the channels of influence it opens for different actors into the policy making process and the economic decision making process makes the financial sector an active player in shaping our economy. And by shaping our economy, it also shapes the interactions between human activities and nature. So sustainability has gained significant ground in finance this past years, mainly this past 2 decades. And there is at least 3 indicators that show us that. Firstly, it's interesting to see that there is a growing number of volunteer initiatives that are led by both public and private actors, and these voluntary initiatives aim to some extent to incorporate sustainability topics into financial decisions. Here I mentioned a couple of examples. You have the NGFS, the TNFD. I'm happy to present this different initiative more in details later on if you guys have questions, but the idea here is just to show that we have more and more of these different initiatives, and they also take ever-growing share in the debate. Second indicator of the growing interest of sustainability in finance is the fact that there is a growing number of green finance products that are being developed and traded by the industry. So you probably all heard about green bonds or ESG ratings that have been around for a while now. But also recently, we see the emergence of the so-called nature markets, for example. So this include biodiversity offset, biodiversity credits, and we can also include in there carbon credits, for example. So all these different financial vehicles that aim to channel finance toward conservation, nature conservation activities, and also to make these kind of activities more interoperable with financial markets and financial systems. And finally, a last indicator is the fact that, especially at the EU level, actually, we have a growing number of policies that aim to green the financial system. And here again, I can mention a couple of examples, such as the CSRD or the green taxonomy that some of you might know already. Okay, so once we said that, once we acknowledge the fact that there is a growing momentum for sustainability in finance, what else can we say when we look at these different initiatives in details? What do these sustainable finance initiatives tell us about the underlying theory of change behind sustainable finance? Three observations can be made, at least. And the first one is that these different initiatives tend to always put the emphasis on information. It's about improving disclosure standards. It's about improving risk assessment methods. All in all, the idea is to make information available to market actors, to make the risk visible, with the underlying assumption that if information is available, if the risk is visible, then actors are going to transition by themselves toward a greener trajectory. And this, some have argued, a rather strong assumption. Second observation that we can make is the fact that these different initiatives tend to focus on rewarding good practices. We talk here about voluntary standards for most of them. And it's also interesting to note that the so-called green taxonomy, which is an EU regulation that establishes a classification of economic activities on whether they can be considered green or not. It's interesting to note that there is not such a thing as a brown taxonomy, for example. And this is actually very common here. Something that we see repeatedly is the fact that The agenda goes relatively fast when it comes to putting forward these good practices, but when it comes to naming, identifying, and targeting broad activities, actors also that are significantly contributed to nature degradation and climate change, it becomes much harder, and the agenda is actually much less advanced on that. And finally, the last observation that we made is the fact that these different green finance initiatives always frame the topic of sustainability in finance as a purely technical problem that requires technical solutions. As I said, it's about better information, better risk assessment methods, but debate regarding a long-term vision for finance. If we have to think about a financial system that is truly aligned with sustainability objectives, um, there is very or relatively little debate on such vision. How such financial sector will look like, what are the underlying goals, values, objectives, beliefs that currently shape the financial system, and to which extent they are aligned with this sustainability and transformative change agenda. All these questions are to some extent being not addressed deeply. And this leads me to one of the main research question I'm trying to address through my research is how can we think about a sustainable finance policy agenda that will truly embrace this transformative change approach, this transformative change agenda. And when I say transformative change, here I refer to the IPBES definition, which means a fundamental system-wide shift in views, structures, and practices. And in one of the papers I'm working on, together with Francisco and Jean, we try to address these questions, and by building on the literatures and also on the conceptual framework that I'm not going to present here, we ended up with three paradigm shifts that we believe draw interesting avenues to think about let's say, future-proof financial system. And thinking about these long-term views also help us to identify concrete policy interventions at the shorter term that will help moving towards these shifts. And by doing this, we can draw some kinds of policy pathway, transformative policy pathways for sustainability in finance that links short-term intervention to long-term views. So I'm going to present these three paradigm shifts in details here. And the first paradigm shift is a shift from external to a nature-embedded financial system. So if we go back 30 to 20 years ago, we were stuck in what can be called a neoclassical paradigms when it comes to economics and finance. So economic value was assumed to come essentially from capital and labor, and nature was not considered as being relevant because the ecosystem services that are provided by nature were considered to be infinite and free of charge. As a consequence, the benefits that they provide, as well as the potential costs that will follow if we came to lose these ecosystem services, were not factored into financial and economic decisions. Now, as I said, it changed a bit because financial actors increasingly acknowledge the fact that they are exposed to new kinds of risk because of nature degradation. But these risks are still essentially being considered as being exogenous, meaning financial actors ask the extent to which they're exposed to this risk, but not the extent to which they might contribute to them. The risk is also often being seen as hedgeable, meaning that it can be managed by having more diversified portfolio. And there's also this overall idea that such risk can be quantifiable by using probabilistic methods and by also attributing a monetary value to it. And this kind of vision has led to very specific policy responses that are focused on a single materiality approach, focused on macroprudential policies, diversification of portfolio to address this risk, and also that has put forward backward-looking risk assessment methods that essentially rely on historical data to quantify these risks. What we put forward in our paper is the need to go toward a vision of the financial system as being embedded in nature. So the financial system is not external, it's actually a subsystem of a broader socio-ecological system. And from this perspective, the risk is seen as being endogenous because financial actors are not only exposed but also responsible for this risk through the activities they finance. The risk is also systemic, so it cannot be fully addressed by having diversified portfolios because at the end of the day, the whole economy and the whole system is going to be affected. And the risk is also complex in a way that it is hardly quantifiable, since we're facing events that have never happened before, relying on historical data to prevent them is not so useful. So we need new kinds of policy responses that take into account this double materiality approach. That also takes into account the systemic perspective, so that moves more toward the macroprudential approach of risk. We need forward-looking risk assessments that rely on scenario analysis, and we need a precautionary principle that will allow us to navigate this deep uncertainty. So the second paradigm shift that we put forward is a shift from market fixing to market shaping. So building on the literature and the different researchers that worked on the topic, we put forward this shift because we can see that the dominant approach to policy making nowadays is very much focused on this idea that financial markets are efficient. So this means that we assume that markets are composed of rational investors that make optimal decisions, and that markets deliver a social optimum, meaning that they allocate capital in the best way for society, because markets is considered to be the best, the optimal tools or the optimal mechanism to process information. From this perspective, the role of the state is assumed to be the one of a referee and a corrector of market failure, and the interventions of the states must essentially be focused on promoting a fair competition in the market, enforcing property rights, and increasing informational flows. The shift that we and older scholars also put forward is a shift toward an approach of shaping market instead of just fixing them. And this means acknowledging the fact that markets are not necessarily efficient, they're actually adaptive. Markets change, they learn, they evolve based on the changing environment, and the role of the state is to shape markets in a way that it delivers on social ecological goals. So the role of the state is to establish rules for the market, to steer the economy towards these goals, and to drive innovation and resilience within our economy. And concretely, this means interventions such as public investments into innovation and into nature positive activities, strong regulatory framework, and also regulations that create accountability for for economic actors that damage nature, climate, and society. So all in all, the idea is a society that sets a direction and the states that ensure that the market follows this direction and deliver on these goals. The last paradigm is a shift from shareholder primacy to stakeholder value. So the current paradigm is very much focused on the shareholder primacy, meaning that the firm, the corporation is seen as the property of its shareholders. So the overall goal of the company is to maximize its profit for its shareholders. Then the fiduciary duty of the board of the company is to pursue the financial interest of the shareholders. The shift that we put forward here is a shift from shareholder primacy to stakeholder value. So the idea is to see the firm for what it is legally, meaning its own legal person, but also a common good with multiple overlapping claims. So a firm is actually composed of a community of different stakeholders, including but not restricted to stakeholders. We also have communities that are affected by the activity of the firm. We have customers, workers, etc., etc. So the raison d'être, the aim of the firm is to increase the welfare of this community of stakeholders. And the fiduciary duty of the board of such company will be to balance the interest of these different communities. And from this perspective, policy interventions that will go in this direction will promote inclusive corporate governance that will formalize such extended definition of fiduciary duty, or also that will establish a reporting obligation that also fit the interest and the views of these different stakeholders, and not only having reporting obligations that are focused on financial contributors of the firm. Okay, so now I presented these three paradigm shifts, and what we find interesting with this paradigm shift is that they allow us to, as I said, identify policy interventions at different levels. And something interesting also is that these three paradigm shifts can be linked to three scales of the financial system. For example, the macro scales, that is basically the scales that look at the interaction between the macro financial system with nature and society as a whole, can be linked to the shift number one, meaning move from external to nature embedded financial system. At the mesoscale, meaning interaction between institutions within the system, the paradigm shift number two, from fixing market to shaping them, also allows us to identify policy interventions. And finally, the third paradigm shift, from shareholder primacy to shareholder value creation, addresses the micro scales, meaning the scale within institutions, within corporation, and this one deals with interactions between stakeholders within the different institutions. So here we not only have three paradigm shifts, we also have three scales of systemic scales and three scale of interventions, which allows us to draw on synergies between different policy interventions. And this is also a way to increase coherence and synergies between policy interventions when we think about transformative change. I don't know if I have much time left, so we try to draw on this exercise and to kind of think about what such, let's say, transformative policy pathway would look like. And then, so building on this paradigm shift and this framework, we started to think about, okay, if we have to design such policy pathways, we want to link shallow interventions, so low-hanging fruits. So this is what is being done right now. So, for example, nature-related risk metrics, etc., to long-term views. So from external to embedded financial system. And then at different level of the system, we can think of interventions that to short, medium, long terms that's all aligned with these long-term views. And by doing so, we can think about a set of intervention, a policy interventions that will be overall coherent in terms of timing, in terms of transformative change, and in terms of long-term vision. So this is what we did, for example, for the first paradigm shift. It can also be done for the second paradigm shift and for the third paradigm shift. And here, for example, we end up with a policy package that addresses the issues of sustainability from a transformative change perspective, having a long-term view because it is entrenched into this long-term paradigm shifts, but also present short-term concrete interventions and addresses several scales of the system, the macro, the meso, and the micro scales. And overall, we think that this different initiative put together gives us a set of interventions that has promising potential to bring about transformative change and move the financial system toward a future-proof trajectory.